Welcome to Magellan's latest global update with Hamish Douglas, the portfolio manager of the Magellan Global Fund. Hamish, Europe's a very topical issue at the moment. What are your insights into how the European debt situation is going to evolve?
Well, Emma, Europe is the big risk issue in the world from our perspective, and therefore a focus on Europe is very important. I've updated our investors fairly recently on Europe. The two big issues is obviously the solvency issues centred around Greece, potentially Portugal and Ireland. There has been a new bailout facility that's been announced but hasn't yet been put into place. We've said before that we view this new bailout facility and the new terms of the facility as being a fundamentally good step in the right direction. It is really, we think, the proper answers to the solvency issues. They may have to go further. The issues the market's been concerned about is the new program's not in place yet. But there have been some positive developments in the last week or so. The German cabinet approved the new terms of the bailout. It hasn't gone to the parliament yet, but the cabinet has approved. Yesterday, the High Court, the Constitutional Court in Germany, actually ruled against a challenge to the constitutionality of Germany participating in bailout. So it's legal now for Germany to participate in bailout packages in Europe. There are a few niggling issues going on. Finland has said if they're going to participate, they want to have collateral against the loans that they would extend. And of course, a few other countries are saying, well, if they're going to have collateral, what about us? So people are uncertain as to whether this new bailout program will actually get put in place. We're actually very confident it will get put in place, particularly with the recent positive developments in Germany. It's not going to be in place until really the end of October, and we're likely to see continued volatility until this very important new bailout program is put in place. And the new bailout program only doesn't deal with Greece. What it does is give the stability mechanism fundamentally new powers, particularly new powers to go and buy bonds in the secondary market, which we think is a very important power. The power to extend loan terms and reduce interest rates to countries that they've lent money from sort of 3 years up to 30 years, and interest rates down to 3.5%. So fundamentally a lot more attractive in terms of getting these countries on a sustainable path, and they've introduced a new clause for private sector participation in terms of swapping their old sovereign debt in Greece for new sovereign debt that is more attractive and much longer duration and lower interest rate. Whether it's enough, we are not sure, but we think it's the right tools to address these solvency issues. And it's our view a sovereign default in an uncontrolled sense is the biggest risk for the world. It would be like a Lehman Brothers event on steroids, but we don't think it's going to happen. And actually we think it's quite attractive to think about investing at the moment because we're highly confident this new program will be put in place, notwithstanding all the political noise that has created a lot of uncertainty in the last few weeks. The other issue in Europe is what we call the liquidity issues in Europe, and this is the risk that countries like Italy and Spain, that their bond yields go to such high levels that their positions become unsustainable. Of course, they don't have debt levels nearly as high as Greece and have much stronger budgetary positions. So they're not insolvent, but if their bond yields got to very high levels, the interest on their debt would become very high. So they do have to address those issues. We don't yet have the fundamental policies in place to really address those issues. But again, we're confident that those policies will come into place because Germany realises the importance of addressing those issues. So we are not afraid of an Armageddon event in Europe at the moment. We're obviously monitoring it very carefully. It is the primary reason why markets have been so unsettled in the last 8 weeks, but we're feeling pretty relaxed about the situation in Europe, but watching it very, very closely.
Moving across the Atlantic, how do you see the US's situation playing out at the moment?
Well, we've been saying for some time we're reasonably relaxed on the United States and its outlook. There's a huge amount of political theatre going on at the moment about the debt position. Obviously, we got through the debt ceiling debate with an extension to the US federal debt ceiling. It would have been an absolute catastrophe potentially for the world had they not extended the debt ceiling. That has now been extended post the 2012 presidential election. We're now getting a lot of debate about how are they going to address their longer term fiscal issues. We have said consistently that we are confident to highly confident that post the 2012 presidential elections, the United States actually has a lot of low-hanging economic fruit, we call it, where they can effectively address a lot of their longer-term fiscal issues. And the other point we've been making is the US is in a housing depression at the moment. Expenditure on housing in the United States is at a 60-year low at the moment. And housing construction is running at 1/3 of the amount of houses that need to be constructed for natural household formation in the United States. They're of course working through a massive oversupply of housing that was built up during the boom years leading from sort of 2002 to 2007, and we think that's going to take another 3 years or so to work through. So we don't think the US is going to bounce back in the very near term, but the housing market will come back. I'm not talking about housing prices, I'm talking about housing construction, and when that comes back, job creation will come back quite markedly in 3 years or so, and a lot of the fiscal pressures will start coming down, plus some new policies we think post-2012 elections we put in place, and we're reasonably sanguine about the outlook there, but there's a lot of theatre. But we're not expecting the US to recover remarkably in the next few years, but looking 3 years out, I think the US is a reasonably attractive place to be looking. So I would call it we're realistic about the short term and optimistic about the medium term in the United States.
So Hamish, with all of this economic uncertainty and volatility in markets, how has the Magellan Global Fund been holding up, and how have some of the companies within the fund been performing?
It's been a very interesting period. Obviously markets in the last 8 weeks have been incredibly unsettled. They've actually been unsettled from about the 1st of April, where a lot of this European news, and then we had the US debt ceiling news, and markets have been incredibly volatile. If I go to the underlying performance of our portfolio and I look at the larger companies, if I start with our companies that are exposed to the rise of the Eastern consumer, and I start at a company like Coca-Cola, you know, in the last quarter its earnings per share were up 10%, but importantly its volumes grew by 5%. Around the world, and interesting, in Europe its volumes in the last quarter are up 5% with all this uncertainty going on in Europe. So Coca-Cola's in very good shape, and in the emerging markets they're in extremely good shape. Yum Brands is another one of our large investments in this space exposed to the emerging consumer. Its earnings per share are up 12% in the last period. Its China division, which is its engine room, its profits are up 25% in China in the last quarter. Its international operations outside China and outside the United States were up 11%. And believe it or not, China, its same-store sales were up 18% in the last quarter. And the last one I'd talk about, which is a large investment in this space, would be McDonald's. Its earnings per share were up 19% in the last quarter. And its same-store sales, if I just pick out Europe, were up nearly 6% in Europe. So we have some of these companies, notwithstanding they're operating in some areas that are facing a lot of economic difficulty, because they're advantaged, they're still growing very well in those areas. If I think about the payment space, and I look at two of the larger ones, Visa and MasterCard, Visa's earnings per share are up nearly 30% in the quarter. Its total payment volume was extraordinary. It was up 13%, nearly $941 billion of transactions were processed on the Visa network in 3 months. And if I look at what happened in the United States, for instance, you know, the US is facing a very difficult short-term economic scenario, but the payment volume, because this company is advantaged and volumes are transitioning out of cash, was up over 10% in the quarter. MasterCard was even stronger in the last quarter. Its earnings per share were up 36%. Its total payment volume was up 16%. Believe it or not, in Europe, and remember people are very concerned about Europe, and we're very concerned about the outlook for Europe, And I should mention, while I'm confident the US may start recovering in the next 3 years or so, I'm not confident that Europe is going to recover. While I don't believe there's going to be financial Armageddon, Europe's in a very, very difficult position looking out for many years into the future. But the European volumes in MasterCard were up 14% in the quarter. And if I look at our internet-enabled businesses, and I think about the business of Google, its revenues are up 28% in the quarter. The earnings per share were up 35% in quarter. Google is a remarkably advantaged business. Its volumes, which are measured by paid clicks, were up by 18%. And Google's our largest investment at the moment, and its share price performed very well over this period. eBay is another investment that we think is very advantaged in two areas. One is in e-commerce. Its total volume in e-commerce was actually up 17% in the quarter. The US was up 14%, its e-commerce volume. So again, you're getting this transition. Notwithstanding retail sales are very slow in the United States, e-commerce volumes are very strong, as they are in Europe at the moment. The overall earnings per share are up 20%. And PayPal was a business which is in the payment space that's owned by eBay. Its revenues were up by 30% in the quarter, so very strong over the period. And its active users are over 100 million now active users. So for the larger investments we hold, it's been a very, very strong reporting season, notwithstanding these very uncertain economic times in both the United States and Europe. And as I outlined, the business performance of these companies in the United States and Europe have been remarkably strong, notwithstanding the state of the economies in the United States and Europe.
So with all of these risks that you do talk about, do you still think it's a safe time to be investing?
Emma, I think that is a great question, whether it's a safe time to be investing. You know, the VIX, the volatility index, has gone through the roof. Markets have been incredibly volatile. They're off nearly 15% since the 1st of April. Luckily, the global fund isn't off materially at all. It's only off maybe 1 or 2% over that period, largely because of the results of the companies we're invested in. But if I think back to March 2009, when the markets were fundamentally cheap, the exchange rate was 63 cents. The exchange rate today is $1.05 to the US dollar. Markets are up, but now they're coming back. And when I look at where we're invested in high quality and advantage businesses that have strong secular growth, and if we're right that post-October a lot of this uncertainty in Europe, the temperature is going to reduce around that, and with such a strong Australian dollar, we actually think this is a very opportune time to be considering putting more money into very high quality advantaged offshore businesses when the dollar is at $1.05. I actually think, because the strength of the dollar, for an Australian investor, this is as an attractive time to be investing today as it was in March 2009 when the dollar was 63 cents. So when we look at the return profile that we would expect from our portfolio, this has to be one of the most attractive times we've seen for investing in the style of investments we're in. We're not saying there's not going to be volatility. There will be volatility. There's especially will be volatility leading into October. I think some of their concerns will dissipate post-October. That doesn't mean the world's about to take off. Europe is very difficult for the next 5 or 10 years. The United States is very difficult for the next 3 years. We're going to have a very ugly political debate in the United States leading into the November 2012 presidential election. But whilst everyone's so pessimistic and the dollar's so high, I think we should remember we maybe, for the first time in their life, we're Swiss citizens. People in Switzerland have this enormous purchasing power to go and buy foreign assets. Australians have this enormous purchasing power at the moment to buy foreign assets. And I think people just need to have a little bit of courage and think about the quality of businesses that are available offshore and focus on quality and use the very high exchange rate at the moment and understand there may well be volatility, especially for the next 3 or 4 months. There could be more volatility next year with the debate. But we view it as an attractive time in the space we're in.
Thanks, Hamish. And thanks for joining us. If you'd like to discuss any of this further, please contact the Magellan distribution team.